So imagine you run a massive global enterprise. Let's say you're the CEO of a major multinational oil company.
Okay, yeah. High stress job right there.
Oh, completely.
Hmm?
Because you're dealing with, highly unique, incredibly complex risks every single day. Deep water drilling operations, international supply chains in volatile regions, just immense environmental hazard exposures.
Right, the kinds of things that keep risk managers awake at night.
Exactly. And now imagine a hard market hits. You go to buy traditional commercial insurance capacity to cover all these massive operations. And the underwriters, well, they look at your risk profile and they either flat out decline the coverage or they quote a premium. So astronomically high, it just destroys your operating margin.
Yeah, which happens a lot more often than people think.
It really does. So when the traditional commercial market turns its back on you or just prices you completely out, you have to pivot. And the solution, you just start your own insurance company.
I mean, it sounds like complete hyperbole, right? But in the world of high-level corporate finance and, enterprise risk management, that is actually a standard, highly strategic reality for some of the world's biggest corporations. They just bypass the retail insurance market entirely.
Which is wild. And that brings us to today's deep dive for the Insurance Study Companion. We are looking at the mechanics of captive insurance.
A very, very important topic.
Yeah, it's a strategy that sounds almost like a contradiction at first glance, but it really forms the absolute bedrock of modern risk financing. So for those of you gearing up for the CPCU 530 exam, or even if you're just navigating the commercial insurance industry on a daily basis, this is where the theory you're studying meets real-world boardroom execution.
Absolutely. The mission here is to break down how captives actually function, the massive financial incentives driving them, and most importantly, how you can translate all this knowledge into passing your exams.
Right. So let's just start with the baseline definition. A captive insurance company is an insurance entity that is owned and controlled by the business it insures. The owner and the insured are literally the exact same corporate entity.
And that structural reality fundamentally separates it from traditional commercial insurance. Because think about a standard commercial insurer, right? They pool the risk of thousands of completely disparate independent clients.
Right. They rely on the law of large numbers.
Exactly. Law of large numbers across a vast population. But a captive insurer's client list is essentially a population of one, or at least one corporate family. It exists exclusively to underwrite the risks of its parent company.
I want to dig into the why here, because setting up a subsidiary just to ensure your own operations, it feels a bit like building a moat instead of just paying a security company to guard your gates. I mean, it's a massive undertaking.
It is. It's a huge commitment of capital and resources.
So if a company is practicing enterprise risk management, they identify a risk and decide to either transfer it or retain it. Buying a commercial policy is transferring it. Creating captive is retaining it, but putting this highly formalized, heavily regulated wrapper around that retention.
And that formalization is really the key differentiator because theoretically a company could just self-insure, right? They could just decide, hey, we're going to absorb any losses out of our operating cash flow as they happen.
Just pay out of pocket.
Right. But at a massive scale, relying on operating cash flow for unpredictable, severe losses is just terrible capital management. It's way too volatile. So by building a captive, yes, they are retaining the risk, but they are applying strict actuarial discipline to it.
They're treating it like a real science.
Exactly. They are funding a separate legal entity with adequate reserves, they're pricing the premiums based on historical loss data, and they're managing the whole thing as a standalone financial operation.
Okay, so let's talk about the specific financial mechanics, because I think this is where this strategy actually proves its worth. If a company is just paying premiums to a subsidiary it already owns, on a consolidated balance sheet, the money hasn't really left the building.
Right. It's just moving from the left pocket to the right pocket.
Exactly. But the tax and accounting implications make a captive fundamentally different from merely setting up a cash reserve account at the bank.
Oh, 100%. And honestly, this is often the biggest aha moment for professionals who are analyzing risk financing. So let's say a corporation simply sets aside $50 million in a bank account to cover potential future liability claims. That $50 million is not tax deductible.
Wow. Even though it's specifically for risk.
Nope. The IRS considers that self-insurance, and you cannot deduct a loss until the loss actually occurs.
Okay. That makes sense from the IRS's perspective.
Right. However, if that same corporation pays $50 million in premiums to a formally licensed heavily regulated insurance company, even if it's their own captive, that premium payment is generally recognized as a deductible business expense in the year it is paid.
Because on paper, it's a legitimate risk transfer mechanism.
Mm.
The IRS recognizes the captive as an independent financial entity.
Exactly. So the parent company lowers its taxable income today, while the captive takes in that premium revenue to build up its reserves.
It smooths out the financial volatility. Like the parent company converts these unpredictable, highly variable potential losses into a fixed, predictable annual premium expense.
Which CFOs absolutely love, by the way. Predictability is everything.
So let's apply this to a real-world scenario to map out the cash flow, because I think that helps visualize it.
Yeah.
Let's use a hypothetical model based on a massive global retailer, say Apple.
Good example, huge footprint.
Right. So Apple expects to face high-frequency, somewhat predictable losses across its global physical operations. Slip and falls in retail stores, minor property damage, workers' comp claims, supply chain friction, stuff that happens every year.
The cost of doing business.
Yeah. So if they go to a commercial insurer, the underwriter looks at their data, calculates the expected actual losses at, let's say, $100 million. But then they tack on a 20% margin for their own overhead, their marketing, and their profit. So they quote Apple a $120 million premium.
And Apple, recognizing that they already have the cash flow to absorb the $100 million in actual expected losses, realizes they are essentially throwing away $20 million just to use the commercial insurer's balance sheet.
Exactly. So instead, Apple funds a pure captive. They pay that $120 million premium into their captive subsidiary. The money shifts from an operating expense to premium revenue within their own corporate family. And throughout the year, when a customer slips in a store, the captive pays the claim. But let's say Apple implements an incredible new safety protocol, and they only suffer $80 million in actual losses that year.
Yeah.
In a traditional commercial relationship, that remaining $40 million is pure underwriting profit for the commercial insurer. Apple never sees a dime of it.
They're essentially penalized for having good safety practices.
Right. But with a captive, that $40 million of underwriting profit stays in-house. It builds up the captive surplus, and that surplus strengthens the overall consolidated balance sheet of the parent organization.
The parent is actively capturing the underwriting profit that a third party would normally just extract from them.
And that money isn't just sitting idle either, because insurance operations are built on float. The captive collects the $120 million on day one, but it might take years for some of those liability claims to actually settle and be paid out.
Oh, liability claims can drag on for a decade easily.
So during that gap, the captive is investing those premium reserves in the capital markets.
And this is huge. The investment income generated on the unearned premium and those loss reserves becomes a completely new revenue stream. Because when you utilize commercial insurance, the carrier keeps the yield generated by your premium dollars.
Right, they get to make money on your money.
Exactly. But a captive repatriates that yield back to the parent company. Over a 10-year horizon, the compound growth of that investment income can significantly offset the overall cost of risk.
This level of financial control really explains why so many Fortune 500 companies have pure captives. I mean, we are looking at massive airlines, global logistics firms, energy conglomerates.
Pretty much the big players.
But a pure captive, which is a single parent owning a single insurer, requires immense capitalization. If you're a mid-size enterprise, maybe a regional hospital network, you face the same severe risks and the same punitive commercial insurance margins, but you definitely do not have hundreds of millions in spare capital required to satisfy regulators and spin up an entire insurance subsidiary.
Yeah, that seems like a massive structural disadvantage for anyone outside the Fortune 500.
It really does. So how do mid-market companies handle this?
Well, the industry recognized that barrier, which led to the evolution of the group captive. And this structure really democratizes the captive strategy for those mid-market players. So in a group captive, several distinct non-related businesses pool their resources to jointly own and capitalize a single captive insurer.
Okay, so like 10 different regional hospital networks who don't compete directly because of their geography, can band together.
Exactly. Individually, they can't meet the regulatory capital minimums, but collectively, they aggregate their capital, they pool their premiums, and they share the risk across a much broader base.
So they basically gain the economies of scale that a Fortune 500 company has naturally.
Right. They capture their own underwriting profit and investment income, and they finally escape the cyclical pricing of the commercial medical malpractice market, which is notoriously volatile.
And there's a variation of this design around specific trades, right? Like the association captive. It operates on a similar pooling mechanism, but it's tailored to overcome sector-wide underwriting prejudice.
Yeah, association captives are incredibly effective when a specific industry faces a hard commercial market. Consider a National Association of Commercial Roofers, for instance.
Oh, roofing, yeah. Lots of claims there.
Right. Traditional commercial carriers might view roofing as inherently high risk and just unilaterally spike workers' compensation premiums across the board, completely regardless of an individual company's safety record.
Which is so frustrating for a safe business owner.
It really is. So the trade association can form a captive to underwrite its members. And because the association understands the specific nuances of roofing risks way better than some generalist commercial underwriter, they can price the premiums more accurately.
They know the actual risks versus the perceived risks.
Exactly. They can also implement industry-specific loss control mandates and basically stabilize the costs for their members.
That bespoke underwriting is a massive operational advantage. You don't have to fight with a commercial underwriter over, obscure policy language. You are literally drafting the coverage manuscript yourself.
Right, you're the one holding the pen.
Exactly. So if you have an emerging risk like really complex cyber liability exposure or a highly specific supply chain bottleneck that commercial carriers refuse to touch because they lack historical data, your captive can write a policy tailored exactly to that vulnerability.
You fill the gaps in your corporate risk profile that the commercial market simply refuses to cover. You ensure that every operational exposure has a formalized financial backstop.
But wait, I have to play devil's advocate here. Running an insurer means dealing with an entirely different universe of compliance. I mean, you are taking on an immense regulatory burden. The catch here has to be the overhead and the sheer legal complexity of operating a regulated financial institution. You aren't just opening a checking account in Delaware.
Oh, absolutely not. The barriers to entry and the operational frictions are substantial. A captive is not a paper company. It is a legally recognized, heavily scrutinized insurance entity. You must undergo rigorous feasibility studies before you even start.
Just to prove you can do it.
Right. And you have to hire independent actuaries to prove to regulators that your premium pricing is mathematically sound and that your reserves are adequate. You need third-party claims administrators, legal counsel, specialized accounting teams. It's a whole operation.
Plus, you have to navigate domicile selection. You can't just incorporate a captive anywhere and call it a day. You have to find jurisdictions with specific regulatory frameworks built for captive insurance.
Domicile selection is a crucial strategic decision. Regulators in places like Vermont or Bermuda, they have developed highly sophisticated, specialized legal frameworks specifically for captives.
Right, they kind of specialize in hosting them.
Exactly. They understand that a captive only insures its parent, so it doesn't need the exact same consumer protection regulations as, say, a retail auto insurer selling to the public. But even in a favorable domicile, the capitalization requirements are stringent. Solvency is the regulator's only concern.
Which leads me right into the biggest structural vulnerability I can see here. What if, say I am the CEO of a global shipping logistics company. I've successfully navigated the regulations, funded my captive, and retained my risk. What happens in a worst-case scenario?
The doomsday scenario.
Right. A geopolitical event shuts down a major strait. I lose 3 cargo ships in a week, and my entire supply chain is frozen. My captive faces an unprecedented string of catastrophic claims. Since the captive is a subsidiary, if those claims blow through the captive's capital reserves and drive it into insolvency, that financial black hole directly impacts my parent company. I've essentially concentrated my catastrophic risk instead of shedding it.
Yeah, and risk concentration is the absolute nightmare scenario for enterprise risk management because a captive is perfectly designed to absorb high-frequency, low-severity risks, the predictable frictional costs of doing business.
The slip and falls.
Right. It is absolutely not designed to absorb a company-ending catastrophic shock all on its own. The mechanism that prevents the scenario you just described from bankrupting the parent company is reinsurance.
Ah, okay. The wholesale market for risk. So the captive doesn't operate on an island. It acts as a conduit to the global reinsurance market.
Precisely. A properly structured captive will only retain the primary layer of risk, say the first $10 million of any given loss.
Okay.
For any exposure above that threshold, the captive purchases a reinsurance treaty from global reinsurers, like Swiss Re or Munich Re.
So the captive is paying a portion of its collected premium to the reinsurer, essentially buying an umbrella policy for itself.
Exactly. The captive transfers the catastrophic tail risk while retaining the predictable frequency risk. This creates a highly efficient capital structure. The parent company still gets the benefits of lower frictional costs, customized policy forms, and capturing the float on that primary layer.
But if those 3 cargo ships sink,
Right. If disaster strikes, the captive pays the primary layer, and the global reinsurance market absorbs the hundreds of millions in catastrophic excess limit.
and this access is a fundamental advantage, because a corporation cannot typically buy reinsurance directly. I mean, reinsurers generally only do business with other licensed insurance entities, right?
That's right. The captive serves as the necessary legal bridge. It allows a manufacturer or a hospital system to bypass the retail commercial insurance market entirely and access wholesale reinsurance capacity directly at a much lower cost of capital.
That's brilliant. And, the psychological shift this creates within the parent company is also worth highlighting. When a company relies entirely on commercial insurance, there is an inherent moral hazard.
Right, definitely.
A facility manager might subconsciously deprioritize a $1 million sprinkler system upgrade because ultimately, if there's a fire, well, it's the insurance company's financial problem. But when the parent company utilizes a captive, that hazard basically evaporates.
The incentive structure aligns perfectly. Because the captive's surplus and its losses directly impact the parent company's consolidated financials, every layer of corporate management becomes hyper-focused on loss control. They aren't spending the carrier's money anymore, they're spending their own capital.
So the parent company suddenly has this massive financial incentive to invest in advanced ergonomics to reduce workers' comp claims or aggressive cybersecurity infrastructure to protect their digital assets. The captive mechanism forces the entire enterprise to elevate its operational safety standards.
It transforms risk management from a localized compliance function into a core driver of corporate profitability.
Okay, so for those of you out there translating this boardroom strategy into exam points for your CPCU 530, or if you're preparing for an underwriting designation, let's build the playbook. We need to clearly define the traps examiners use to test whether you truly grasp these mechanics rather than just memorizing a few flashcard definitions.
Good call. So the most common testing pitfall involves blurring the lines between commercial and captive entities based on operational descriptions.
How so?
An exam question might describe an entity that provides customized coverage and retains investment income, but also markets policies to independent, unaffiliated businesses. You must recognize that the moment an entity sells coverage to the general public or unassociated third parties, it loses its defining characteristic as a captive.
It basically transitions back into a commercial carrier because the primary function of a captive must be financing the risks of its owners. If it's selling to strangers, it's not a captive.
Exactly. Examiners also frequently test the structural boundaries between pure and group captives. So pay close attention to the capitalization narrative in a scenario. If the question details a single parent company injecting capital to cover its own subsidiaries, you are dealing with a pure captive.
Right.
But if the scenario involves a pooling of capital from multiple distinct corporate entities to overcome regulatory minimums, it is clearly steering you toward a group captive.
Let me give you all a memory device that cuts through the complexity. If you lock this phrase in, it centers the entire concept for the exam. Own the insurer, retain the profit, reinsure the catastrophe.
I like that.
It hits the 3 critical phases, right? You own the entity to dictate the terms, you retain the primary risk layer to capture the underwriting profit and the investment float, and you utilize the reinsurance bridge to protect the corporate balance sheet from catastrophic insolvency.
That sequencing is absolutely essential for the exams. Build the entity, underwrite the predictable risk, capture the float, and offload the tail risk to the wholesale market.
And as a final visual map for your coursework, picture the entire ecosystem as a continuous flow of capital and risk. It originates with the operational enterprise risk at the non-insurance parent corporation. That risk flows into the captive subsidiary, which acts as a holding tank for the predictable elements. The captive then acts as a valve, transferring the massive, unpredictable risks up into the reinsurance market. And finally, the reinsurance market disperses that risk across the broader global capital markets through retrocession and catastrophe bonds.
It's beautiful, really. The captive is the vital mechanism that connects a corporate logistics firm or a retail chain directly to the macroeconomic capital markets. Without the captive, they are just trapped in the retail insurance cycle.
It is an incredibly powerful tool. So to summarize the tactical takeaways for you guys, a captive allows massive organizations to finance their own risk efficiently. They eliminate the commercial underwriter's profit margin, they draft customized coverage for emerging or obscure risks, and they capture the investment yield on their own premium reserves. Furthermore, by accessing the wholesale reinsurance market, they secure the catastrophic capacity necessary to prevent a massive loss from taking down the parent organization.
It completely redefines capital efficiency for the Fortune 500. And, understanding the structural shift raises a critical and slightly provocative question about the future landscape of the traditional commercial market.
Oh yeah. Where is this all heading?
Right, because we are witnessing an ongoing migration where the most highly capitalized, sophisticated corporations in the world are increasingly pulling their premium dollars out of the retail commercial system.
They are opting out of the traditional pool entirely. They're just taking their ball and going home.
Which leaves a profound macroeconomic consequence. If the world's largest companies, who, by the way, often have the best loss control and the most predictable risks, are bypassing traditional carriers to deal directly with reinsurers through captives, what happens to the commercial carriers left behind?
Wow. The traditional market faces severe adverse selection. It's like a scenario where every single driver with a perfect safety record decides to self-insure. The commercial auto pool is left holding only the high-risk drivers, which forces premiums even higher, driving more companies to explore alternative risk financing.
It creates a really challenging dynamic for traditional insurers who rely on those massive corporate premiums to balance their own portfolios. It fundamentally shifts the balance of power in commercial risk financing.
That is a massive paradigm shift for the industry to navigate, and definitely something for you to analyze as you continue your CPCU studies. Think back to our oil company from the beginning. They didn't accept the limitations of a hard market, and they didn't accept the punitive costs of the retail sector. They internalized the financial mechanics, built a bridge to the global capital markets, and changed the rules of their own risk transfer. Thank you so much for joining us for this deep dive. Keep analyzing the mechanics behind the concepts, and we will catch you on the next one.